Is GME a holding company or just hype? The market is asking if GME is actually transforming into a holding company or if this is just more hype. To find the answer, we have to look past the noise and dive into the latest SEC filings. The tension here is a high-stakes gamble between a shrinking retail core and a massive new war chest. We are analyzing how GME is using billions in convertible notes to fund a pivot toward a diversified investment firm. This shift comes alongside a rapid contraction of their physical footprint. Let's break down the numbers to see if this evolution is sustainable. The most critical number in the GameStop filings is $42 billion. This represents the total value of 0% convertible senior notes the company has issued. This mechanism provides GameStop with an immediate and massive injection of liquidity. By issuing these notes, the company is essentially creating a war chest to fund a fundamental shift in its business model. The goal is to transition from a traditional retailer into a diversified investment firm. While the 0% rate keeps immediate interest costs low, these notes create a significant future liability that must be addressed. The bull case for this strategy relies on the scale of that $42 billion fund. This capital allows for transformational acquisitions that could redefine the company. It also enables a strategic pivot toward high-margin collectibles. By moving away from low-margin hardware and software, the company aims to capture more profitable revenue streams. This transformation is supported by a drastic reduction in overhead. In fiscal 2025, GameStop closed 727 stores. This rapid contraction of the physical retail footprint is designed to slash operational costs and lean out the organization. The bear case focuses on the extreme risk of this high-stakes evolution. The company is relying on massive debt to survive a shrinking retail core. If the pivot to a diversified investment firm fails to generate returns, the company faces a high risk of insolvency. The $42 billion ability remains a looming threat if the company cannot execute its new strategy. The closure of 727 stores proves that the legacy business is contracting quickly. This leaves the company in a precarious position where it must successfully reinvent itself or face total collapse. The key signal to watch for next is the announcement of a controlled transaction or a specific acquisition using the proceeds from those convertible notes. The debate over GameStop now centers on whether this is a genuine holding company transformation or just more hype. The strongest bull case rests on a $4.2 billion war chest. This liquidity allows for transformational acquisitions and a strategic pivot toward high-margin collectibles. However, the clearest risk is the combination of extreme debt levels and a shrinking retail core. The company closed 727 stores in fiscal 2025, creating a high risk of insolvency if the pivot fails. The massive liability of the 0% convertible senior notes looms over the balance sheet. Investors should now watch for the announcement of a controlled transaction or a specific acquisition using those note proceeds. The next move will determine if the company can successfully evolve beyond its physical footprint.